Hey guys, today I'm going to talk about a tool that we use called DIME, D-I-M-E. A lot of people ask me, Chris, Jocelyn, how do you guys figure out how much life insurance someone should have? And it's not just a cookie cutter, number. I don't just say like you should be covered for 100,000, 250,000, half a million, a million. It really depends on four key factors, and we call that DIME. Let me share my screen and show you what exactly I mean by that. So here's Dime. Basically, it's how to determine how much life insurance coverage you need. We use a tool called Dime. Dime stands for debt, income, mortgage, and education. And how do we break it down? Well, D is for debt. Your total debt that you have: personal loans, car loans, college loans, credit cards. I is for income, 8 to 10 times your annual gross income. For example, if you make $50,000 a year, 10 times that is about 500,000, and that's gross before taxes. M stands for mortgage. What's your mortgage balance? And then E is for education, college funding for each child. It's usually about 25 to $50,000 each. So if you add that all up, that's the max protection that you should have. And then based on your budget, we can give a quote and implement a term life policy based on that. Term life insurance gives the most bang for your buck. For the cost per thousand, it's the lowest, definitely lower than cash value. Whole life, universal life, index universal life. You hear about a lot of those types of insurance, but term is the most is the gives you the most bang for your bucks, the cheapest per dollar or per thousand, I should say. So let's go ahead and show you an example how Dime works. Let me share with you my worksheet. And we like to use this worksheet in front of clients so they can see exactly how it works in dollar amounts with their situation. So I'm going to put an example family here. Let's say they have $25,000 worth of debt. That's credit cards, car notes, etc. For the primary breadwinner, let's say he or she makes $50,000 a year. So times 10, that's going to be half a million, 500,000. Let's say he or she, the spouse, makes 30,000 a year. Well, times 10, that's 300,000 right there. Let's say the mortgage balance is about 250,000, right? Not true in San Diego, right? Education, let's just say they have two kids, and we'll go with 25,000 each. So that's $50,000. So max total coverage for the primary would be $825,000. And for the spouse, it would be $625,000, right? So some people say, well, that seems like a lot. I don't need that much in case I pass away. Well, remember, life insurance, we believe in getting properly protected, not just for burial, but to take care of everything and also leave income for the family to survive, because we can't replace people, but we can replace the income. So let's go ahead and transfer this over. So we'll just go ahead and work with the primary example. 825,000 is the max coverage, right? Minus the debts, that's 25,000. If you so something happens to the primary breadwinner, the life insurance death benefit of 825,000 will do this. It'll pay off all the debts, right? So that leaves 800,000. It'll pay off that mortgage. Pay off the mortgage, that leaves what? 550,000. Now we have all debts paid and the mortgage paid, free and clear home for the family. And then you invest 50,000 for the college funds for the young kids. That leaves what? 500,000. Now with that 500,000, right, out of that death benefit, we will invest that. We'll work on it. See, the great thing about us and the company we're with is we're fully licensed. So not only do we work on the life insurance side, we also work on the wealth building side, investments, keeping it separate. So now, let's say 500,000 at 10%, that's 50,000. So let's say uh, invest that 500,000 and it's earning 10% a year. That's 50,000. Well, with that 50,000, right? What do you do with that? Well, you can survive off the interest on that. So 50,000 divided by 12 is about 41.66 a month. So, guys, what happens here is $825,000 death benefit, pay off the mortgage, pay off all debts, fund the college education for the kids. That leaves 500,000. Invest that, living off the interest, just sitting there growing in the right investment vehicle. Living off 50,000 a year, that brings in about $4,200 a month. So we can't replace people, but we can replace the income, and that can last 10, 15 years. We have a number of examples of this happening. where families had 500 to a million. Guys, you know, like the standard now in San Diego, in California, is like 500,000 to a million. That's the standard. If you're covered less than that and you have responsibilities, a mortgage and kids, definitely we need to talk. And if you're paying like a lot of money for very low coverage, we need to talk and do an analysis. We do free analysis of your policies, and many times we can, let that money you're working hard for work better for you. So that's in a breakdown: dime, debt, income, mortgage, and education. And here's a great example of how we help families get properly protected. Hope you got a lot of that. Thanks. My name is Chris Jimenez. My wife and I, Jocelyn and Chris Jimenez, are with Jimenez Enterprises, LLC, and we help families become properly protected, debt-free, and financially independent. And we're always looking for some people to get licensed with us part-time. Thanks and have a good day.